Today, we are diving into the biggest financial market on the entire planet, the foreign exchange market, or Forex. It's this enormous, invisible force that touches pretty much everything, from the price of your morning coffee to your retirement savings. But what's really wild is that for how massive it is, it's also incredibly new. So let's get into why that is. Just to give you a sense of the scale we're talking about, back in 2020, the global Forex market was valued at an almost unbelievable $2.4 quadrillion. I mean, that's a 24 with 15 zeros after it. It is, by a long shot, the most liquid market in the world. We're talking trillions of dollars changing hands every single day. And this right here brings us to a really interesting puzzle. You know, stock markets have been around for centuries, but the Forex market as we know it today, it's a pretty recent invention. So it begs the question, what was the world doing before all this? How did global trade even function without this giant market? To figure that out, we have to rewind the clock. We need to go back to a time before currencies just floated freely against each other. We have to go back to an era when money was tied to something real, something you could actually hold in your hand. That precious, shiny yellow metal. Welcome to the era of the gold standard. The idea was actually pretty simple. Your paper money wasn't just, well, paper. The best way to think about it is like a receipt. It was a promise that you could, theoretically, walk up to a government vault and trade that piece of paper for a very specific amount of actual gold. This gave money a real sense of stability, a tangible value. And this system is the exact reason a huge Forex market just wasn't necessary. Think about it. If the British pound is worth a certain amount of gold and the US dollar is worth another fixed amount, then the exchange rate between them is pretty much set in stone. With that kind of stability, there was very little room, or really any need, for the kind of massive speculative trading we see today. But the whole thing had a fatal flaw. It all relied on trust. It was an honor system, really. Governments would promise they'd only print as much money as they had gold in the vaults to back it up. But when you're facing massive debts from wars or other crises, the temptation to just fire up the printing presses was often way too strong. And when they did that, they secretly devalued the currency, which just wiped out people's savings through inflation. So after all the economic chaos of the Great Depression and World War II, the Allied nations knew they needed a better way, a more formal system. This led to a huge landmark agreement that was designed to fix currencies for good and hopefully prevent the abuses of the past. And this was the Bretton Woods system. It created a whole new hierarchy for money. So at the very top of the pyramid, you had gold, and its price was locked in at $35 an ounce. Then, right below that, sat the US dollar. It became the world's reserve currency, the only one you could directly exchange for that gold. And then every other currency, the German mark, the Japanese yen, you name it, was pegged to the US dollar. It was this big attempt at engineered stability. And, for a little while, it actually seemed to work. But, yeah, that old problem started to creep back in. The system was just too rigid to handle the dynamics of the real world. As some economies started booming and others struggled, those fixed currency pegs became strained, completely unrealistic. And in the end, when countries, and that includes the US, needed an easy way out of debt, they fell back on that old habit, printing more money and choosing inflation over their international promises. And you better believe other countries noticed. They saw the US firing up the printing presses and realized that the massive stashes of US dollars they were holding were becoming worth less and less by the day. So nations like France basically decided to call America's bluff. They started showing up at the gold window, demanding physical gold in exchange for their mountains of US dollars. The American gold reserves started to drain, and the whole system was pushed right to the edge of collapse. And collapse it did. In the early 1970s, that old world of fixed exchange rates was completely shattered, and out of the chaos, out of pure necessity, the modern Forex market was born. And wow, did it happen fast. The idea itself had been bubbling up for years. Back in '67, the economist Milton Friedman was already making the case for floating currencies. Then, 1971, that was the tipping point. President Nixon went on TV and officially slammed the gold window shut, cutting a dollar's last high to gold. All of a sudden, currencies were floating freely, and a new tool was desperately needed to manage all that risk. Just 1 year later, in '72, the Chicago Mercantile Exchange launched the very first currency futures market. A brand new era had begun. The entire game had completely changed. The world's biggest financial challenge suddenly shifted from trying to keep currencies locked in place to figuring out how on earth to deal with the volatility and the risk of currencies that were now in constant motion, their values bouncing up and down against each other every single second of the day. So, this new market was created to solve the problem of risk. But what absolutely no one saw coming was the powerful and, frankly, unintended role it would soon start playing on the world stage. On paper, the market's functions were pretty straightforward. For a company like Ford selling cars in Germany, it was a way to hedge, to lock in an exchange rate so you don't lose your shirt if the German mark suddenly tanks. It also made international payments way faster. And of course, it created a brand new playground for speculators to bet on which way currencies were going to move. But here's the real twist. The market developed a kind of accidental side hustle, one that turned out to be way more powerful than anything its creators ever dreamed of. It became a global enforcer, a sort of digital watchdog that could instantly punish governments for doing the exact same thing that killed the gold standard, printing way too much money. I mean, the contrast is just stunning. You had the old Bretton Woods Agreement, a formal treaty between world powers, and it was ultimately pretty toothless when it came to stopping countries from inflating their way out of debt. But then, all of a sudden, you have this army of Forex traders, motivated by nothing more than their own personal profit, and they became an incredibly effective check on that very same bad behavior. And this isn't just some abstract theory. In 1992, the speculator George Soros famously broke the Bank of England. He took a massive short position, which is basically a giant bet that the British pound would fall, and he and other traders created so much selling pressure that they literally forced the UK to devalue its own currency. Soros himself walked away with about $1 billion in profit. It was just a jaw-dropping display of the market's raw power over sovereign nations. So this leaves us with a really fascinating question for our modern age. Today we live in a world of fiat money. That's currency that isn't backed by gold, but only by a government's promise to keep its value stable. So in a world without a formal anchor like gold, is it possible that the collective, self-interested actions of millions of Forex traders have become the unofficial, the de facto guardians of our economy? It's a powerful idea, and definitely one worth thinking about. Thanks for watching.